G'day everyone, welcome to this weekend update for global markets. And the title this week pretty much says it all. China has finally made some adjustments to their currency peg against the US. I think there's a chance that this is as much political as it is economic. I think there's probably an element of their economy is starting to struggle a little bit, and they're looking to improve their competitiveness, but there's also a political overtone to this because the Chinese are extremely keen for their currency to be accepted more on a global basis, and this is just one step in that process without wishing to go into too much detail about it. So let's have a look at what happened during the week. But just before that, I'll just mention coming up this Tuesday night, there's a webinar which is a market update. I'm going to go through how things are sitting on the global stage, and also some of the outstanding stocks for 2015-16 that I'm invested in, and also that I'm watching. Now you may recall we ran a live event in Perth last week, and we got some great feedback from that live session. It was a terrific session. Quite a lot of people turned up, and it was very interactive, and the feedback was really good. So I was very pleased about that. So I'll be looking at how I find profitable opportunities. I'll be going through a couple of examples, but most importantly, and you've always got to consider this before you get to looking at individual stocks, and that is how well you're positioned ahead of the event. There's no point in owning, great stocks that you might have bought a little bit too high a price, and then the market as a whole goes into a bit of a correction. Every stock is going to get dragged down. So positioning is really important, and I'll be talking about how I'm positioned at the moment. So that's Tuesday night, August 18. It'll be 7 p.m. Probably won't go till 9 p.m. Eastern. In fact, sorry, it's 7:30 p.m. To 9 p.m. Eastern. That slide is in error. But look, there's a registration link. If you click on specialshareeducation.com.au/online update, then that will take you to a registration page. And I think you'll get a lot out of it, judging by what happened from the live event. So I guess the main event of last week, which was a huge move and really destabilized markets for a couple of days, was China debasing their currency. They devalued the yuan. But just to put it in perspective, and a lot of commentators have made the point that they don't believe that this is part of a currency war. And I know there are several elements to what the Chinese are doing, but to say there's not a currency war in progress is ridiculous when you look at the fact that there's been 47 separate currency debasements in the first half of 2015 alone by different countries. So, you can't say that there's not a currency war in absolute full flight at the moment. And of course, the end result of that, at some point down the track, be that a year, 2 years, 10 years, I don't know when it will be, is that we're going to get into significant financial difficulty as a result of this. And ultimately, gold is going to do well, but I'm certainly not advocating that you do anything with gold at this point in time. So China devalued the yen. It was really an effort to prop up their slowing economy, but it was also a bit political as well. But this is a major change for all asset classes, bonds, currencies, stocks, and also has implications for property as well. So a reasonably big deal, and it's particularly a poor sign for Australia's economy, because it does say something about the demand for raw materials into China. And I think the other impact is that it will tend to influence the US Fed to hold off on putting up rates. The expectation priced into the market is that they will move in September. I think this puts another reason why they won't do it. So I'm still of the view that it won't happen this year, that it won't happen until 2016. But in any case, it's already priced in to markets, so I don't think there's much of an implication there. So turning now to the American stocks, the S&P ended up 14 points for the week, so it ended up positive. There was a few wobbles during the week, and so we continue with this flat to weaker period that we've been in pretty much all year. Now, a 10% correction in the market is something we haven't had for a long time, and it would be a good thing for the long-term health of the market. I don't know whether we'll get it this time or not, but it certainly would be a good thing because we've got this overhang, this expectation that it could occur, and it's one of the reasons that the market's just grinding sideways. Now we've got major support at 2010, which is another 45 points lower than the low we saw last week. But even if it got down to that level, that still only represents a 5.6 correction from the peak. So if we do get a 10% correction, we're looking low 1900s, and technically it's pretty hard to see that happening. So let's just look at the S&P index chart first. So you can see there that we've had this extremely large period of consolidation that's just got tighter and tighter, and it's really been since about February that the market has just gone absolutely nowhere. It's been locked in this 2044 to 2144 range, so basically a 100-point range all year. Now, some people are pointing to this pattern and saying it's a market top, but I can tell you, and if watchers of this of all the material that I've put out over the last several years will know that to get a major top, you start to see a change in character. You start to see wild swings, and the market changes its actual character, and we're just not seeing that yet. Now, ultimately, this might lead to a market top. I'm not saying that it won't, but I'm not seeing any signs of it. And if you start approaching the market by trying to second guess what might happen, then you just get yourself into a heck of a mess. So my strong recommendation is just play it as you see it. And at the moment, there are no signs of a significant market top leading to a correction in place. The market is just going through a quiet, flat period. So play it accordingly. So that's really all I can say on the S&P. It ended up a little bit up for the week, but looked pretty mild. Turning to the Australian market, the Australian dollar still remains in downtrend, but it's just consolidating a bit of a base, and we may continue to bounce around here for a little while around the 72.5 to 75 range. And if the Fed doesn't raise rates in September, then that will tend to support the Australian dollar a little bit as well, and I think that's more likely. So I'd expect the Australian dollar to maybe remain in this range for a little bit longer. Now the ASX 200 had a bad week, dragged down by both commodities and by banks. So it's been the banks that have been holding our index up. Our index fell 120 points, pretty nasty, and we've collapsed back into the downtrend channel that has been in play for quite a period of time, and we're seeing quite a lot of profit downgrades coming through now. So it's not a good scene in the Australian market at all. So if we turn to the ASX 200, so you can see very clearly this downtrend channel that really started in April. We got a breakout which occurred in the middle of July. It broke out of the downtrend channel, but as I made the point at the time, this could just be a false breakout, and we could end up back in the channel, and that's in fact what happened. So we had a false breakout, we came back, we tested the top of the channel, we then got a bounce to form a double top, it came back to the top of the trend channel again, but all the time forming lower lows. You can see 1, 2, 3, 4, 5, it's just lower lows all the way through, and then finally dived back into the channel, and the very strong downtrend continues in the Australian market. Doesn't look good at all. Turning to commodities, gold was up by $20 on the week as a result of what China did. So it's just really a reaction to the currency moves. But the gold stock indices, they only spiked up for a couple of days, and they generally look unconvincing. Let's have a quick look at the gold price charts. This is the weekly chart, so you can see a little bit of a blip off the long term. If we pan back, you can see the long term trend line here, which really started back in 2006. We formed a low in 2008 in the GFC, and now we've come back to that long-term trend line. But it's anything but a convincing bounce at this point in time. And if we look at one of the gold stock indices, the HUI index, you can see we've broken really, really important support way below the GFC lows. Here's the GFC lows, and now we're down to the lows of 2002. So we're down to basically 13-year lows. We got a little bit of a blip up for a few days, but then as soon as the gold price stopped going up, the gold stocks just came off the boil straight away. And because gold stocks tend to lead the underlying metal, then I reckon that's telling us that the gold price is probably going to sag back down again. Copper was steady at 233. It's finding a little bit of support, but really not much. Crude oil was down sharply to 42. Crude oil got absolutely murdered through the week. And the International Energy Agency says that the supply glut will continue until 2016, and I think that's probably being conservative. May well last beyond that. So I wouldn't be looking to try and pick the bottom in energy stocks at this point in time. There's the copper chart. It's in quite a strong downtrend, but a little bit of stabilization over the last week. So overall, wrapping it up, the strategic approach is that if you engage in knee-jerk reactions to the headlines, and there's plenty of nasty headlines around at the moment, then that's never a good way to manage investments. So you've got to try and avoid or resist the urge to react to the headlines. You've got to position yourself ahead of time, and that's one of the things that I've been trying to give you a guide on for non-members all year now, to try and get ahead of the curve. And we've certainly pulled back several months ago. So for me, this is a time to sit and watch. I'd be erring on the side of caution. If we get a spike down in the markets, that would be a time to be starting to look to add to positions. Or if we don't get a spike down in the market, if this sideways action continues, then once we get into October, we might be into a more positive sentiment period. But again, don't try and second guess anything. Just play it as it comes to you. I'd certainly be holding higher cash levels at the moment, without question. And when the time to buy does roll around, I would be restricting my focus to large cap growth stocks that have got reliable earning streams and good value. And that by definition means America, because it's incredibly hard in Australia to buy a stock which has got a decent size to it, that's got reliable earning streams and is still good value. You can find the first two things, but most of those stocks are fully valued to overvalued. So that's a hard equation in Australia. You can do it very readily in America. And also in both countries, beware, there are blue chips out there, household names that people would buy without a second's thought, thinking they were safe. And as members would be aware, I went through an exercise at Share Wealth Club, and I pointed out to one of the world's most bluest blue chip stocks, which is, as I regard it, an accident waiting to happen. So just be careful out there. There's my contact details for anyone that wants more information about how I might be able to assist them. And take it easy during the week, and we'll see you next weekend. Cheers.